All right, everyone. We got, let's see, well, see what team is not in yet. Let's see.
Looks like participants are rolling in, which is great. I'm excited to have this conversation with you, Nachman. I think, like we've talked about for years, inventory is one of the biggest challenges in e-commerce accounting. The straightforward stuff, ad spend and insurance and rent and all the basic expenses are pretty straightforward. Even some of the platform stuff, the fees from Amazon and whatnot are pretty straightforward. But when it comes to inventory, that's always been the single biggest challenge. So I'm excited to talk about what you've built here and first kind of starting just with understanding why it's so important to get it right and how it has such a big impact on your final numbers. But then being able to use a tool that really makes a big difference in being able to get your inventory and your cost of goods sold right in your e-commerce accounting. I feel like that's been kind of the holy grail that we've been we've been talking about looking for years. So I'm excited and I appreciate your coming on and putting this together for everybody.
Sure, sure. So I'm excited to be here. And Matt, we have a relationship already for a while, and I've had a lots of conversations with you back and forth, and this is something that's really super important for the audience. This is something that's, you know, it kind of like I would say wraps around the whole picture of the business, really like gives the last detail of getting the inventory. And I always tell people inventory is going to be your biggest asset on the balance sheet, and on your P&L, it's going to be the biggest expense, your cost of goods sold. So really understanding that part and really having that part clear is like, really, really, really true for that. So we'll begin off with a little education today, explaining a little bit why this is important, and then after like 10 minutes, we'll dive into more like a product demo of demoing the product, and we're gonna show around how the product works, and we will have the Q&A open. If not, then just let us know in the chat. The best thing would be if you can put all your questions in the Q&A. So we'll have a Q&A after at around like a half hour, and we'll take all your questions, and we'll be there to answer everything. All right. Okay. So let's start off. So as we're going to start off is how to understand your true inventory value and the health of it. So we got today, we have two presenters. It's going to be me, and we're going to have Matt, and let's go through. So what we'll be discussing today mainly is the importance of tracking inventory age, the impact of cash flow, and to insights to avoid costly overstock, and how to get accurate valuations across your warehouses and FBA. So let's go through. So the first thing is, which I always say, is inventory is the silent killer. Why do I call it the silent killer? So I always like to joke around with people. I say, like, when it comes to my fees, everybody loves to negotiate. Everybody loves to get a good deal. But the problem is when it comes to buying inventory, when you're shopping around for a product and the guy tells you, "Oh, I can sell you this for $50," and you're like, "Okay, I can resell it for 100." Um, in that instance, you're not thinking of it as an expense. What you're thinking is, "Okay, I'm giving you 50, but I'm going to make 50." The challenge is that, a lot of times certain products don't sell or don't sell as fast enough, and that ends up hurting the margins. So what happens is a lot of times when you're and for I would say the last 7, 8 years, I've been very much focused about understanding profitability on a SKU level, understanding the profitability as a whole, and digging into the P&L side. The problem is the inventory is something that never shows up in your P&L, and it lays in your balance sheet. And that's really why I call it the silent killer. It's because most of the times it gets overlooked because it's just not in the P&L. Most business owners just request from the bookkeeper, send me P&L, looks good, they're happy. Then they face cash flow issues or other stuff, or sometimes, and they don't realize how much on the balance sheet side, the inventory has an impact.
Right.
So
Well, if I could just, yeah. So if you said I can buy it for 50 and sell it for 100, but realistically, you're going to pay Amazon $30. You're going to spend $10 on ads. You're going to spend $2 or $3 on insurance and other things, right? So you buy it for 50, you sell it for 100, but you're only going to make $5, $6, maybe $10 if you're lucky, but that's only if the inventory really costs you 50. If because of losses, overstock, slow sales, interest expense, everything else, that inventory really costs you 55 or 60, what you've effectively done is wiped out your profit margin. That's why your inventory health and the true cost of your inventory is so important, because if that moves from the number you think it is to what it really is, and it goes past the part where you have any profit left, now it is silently killing your business.
Yep, definitely. So I want to take it from one angle, which is I usually like to, whenever I tell clients like this statement and I, actually review their financials online, it resonates a lot with people. And everybody wants to be big. Everybody wants to, build their business and everybody wants to go very high. So one of the things is what makes Costco so successful. And obviously they have their all their different marketing strategies, and they have the way they package their products, the way they sell their products. But one of the things that really stood out to me a lot in Costco, especially when as building this inventory software, was that Costco has a 12x turnover rate. And I've seen so many times working with sellers that they have products sitting there for very, very long in their inventory. And I'm like, why did you buy 6 months worth of supply? Or why did you buy like a year month's worth of supply? And literally don't really have any like direct, answer on that. And they think that, in order to go big, you have to buy a lot. But the answer is that if you look at a company like Costco, which is a nationwide brand, they're in multiple countries as well, they keep their products on their shelf not more than 30 days. They have a 12x turnover. So I tell people, you want to learn, let's learn from the big. Let's see how the big companies do it. Obviously they go very, very big, but they're not buying inventory for 6 months. They'll never buy more than 30 days, and they'll make sure to keep on, spinning that wheel. So the idea is when it comes to inventory, is you want to try to have as a high turnover as you can, which that's going to ease your cash flow. And even I would even add on, Costco actually doesn't even have that many SKUs. I think they only carry like 3,800 SKUs, which is, we have seen sellers with way more than that. But like even Walmart that has like over 250,000 SKUs, Walmart has an 8x turnover. So they have also, Walmart carries also a lot of different type of products. They carry also, Costco is very more like specialized in certain industries, but Walmart has pretty much everything. But even Walmart, they make sure that their products spin over at least 8 times a year. Otherwise, it gets off the shelf and it just doesn't last there. So it's really important to have this clear metric and really understand this part.
Mhm.
So let's go into the next thing. So what I say is when it comes to local inventory, is the question is, what is the metrics, we should be looking at? And I kind of set like a little floor here where like what I look at, I say domestic is, as I gave my previous example, Costco does 30 days, but I would say the most inventory you should have is 60 days. And I would say even the easiest thing you can do right now is if you look over your financials, you want to see how much your cost of goods sold was for the last 2 months and compare that to your inventory asset. Look how far that is apart. That's usually like a very good starting point that I like to do a lot. But like ideally, I want to keep it at 60 days max. We want to try to hit some at 30 to 45 days. Now, if you're doing international, it's a little more complicated because, from when you place the PO till the goods arrive, could approximately take like 3 to 4 months. I would say in that case, we set the benchmark around 120 days at most. So if you have inventory that you bring in from overseas, you have inventory that you're buying locally, what we want to do is we would separate the two. And there's ways to do it in ConnectBooks, which you could run different reports by brands, suppliers, categories, and stuff like that. And what we want to do is, for domestic, we want to try to keep not more than 30 to 60 days, and from overseas, not more than 120 days. And that's really gonna, if you can pull out your cash fast enough, you're gonna constantly keep on reusing the same cash over and over to keep on generating more business. So we say we rather have a higher turnover with better cash flow, even with lower profits. So the idea is that if you have a product that you make less money, but you flip it once a month versus a product you flip once in every 6 months, you rather want to focus on the products that flip fast because that doesn't tie up the cash. So another thing is, which is very important, is the interest cost. you know, holding inventory for a while, if you're taking out a line of credit and you're paying 10% on that line of credit, that's additional fee, that you're paying for 6 months. Meaning if let's say you buy $60,000 worth of inventory and that's for 6 months, you're paying out every month interest on $60,000 as it sells. Versus if you buy, let's say, just for 2 months and you replenish faster, then you're just paying $20,000. You're only paying interest on 20,000 instead of paying on 60,000. So interest cost of holding inventory is also a huge factor, which can also drain a lot of business. And that can help you by optimizing, your cash flow, by optimizing inventory. So, and then the other thing is we'll jump into this, and then after this little topic, we'll go into the inventory, we'll go in more to a demo of the product. So just in time is really, the reason why I bring it up is because I want to explain I want to highlight the importance of having proper inventory management. I do see a lot of times that people don't have like people think like it's not so important, or people always just make sure that okay, so when an order comes in, I always have to make sure I can fulfill it right away for the proper 3PL. But people don't really understand the importance sometimes of not overbuying inventory, and not every deal is a good deal, and not every deal you have to buy, and sometimes you just have to say no. And that's why I'm going to examples of bigger companies, which, for example, a company like Toyota. So Toyota, for example, one of the things the car companies have done a lot to minimize the risk is that they don't stock any parts. They can have parts arriving for that like a couple of hours before they start assembling the car. So I mean, there's cars stocked on a lot, but they don't, let's say, for example, whether it needs a headlight, a tail light, they don't stock all these stuff. They have a production schedule, and based on their production, they can sometimes get it within a couple of hours of the car, of the car being assembled. Now, this is called an just-in-time inventory management, which is a very extreme example. I'm not, referring here that people should run just-in-time inventory management, but I'm trying to show that, a lot of bigger companies, what they're trying to do is hedge the inventory risk and trying not to carry huge inventory. And what you can see is with these kind of companies that, they don't keep it, they keep very, very low stock and they try to spend it really fast. Now, I do want to point out, by COVID that we just passed, we showed a lot of risks, meaning everything went in back order, everything went the wrong way. But I would say we're not anticipating another COVID. So as long as we're not anticipating it and not like that, I wouldn't like really stock that crazy. But this is something it's important to see like how the bigger companies do it. And in that part, we make sure how the bigger companies do it. And once we have an idea, we want to try to copy those and go from on that angle.
I can think of two things that might be going through people's minds when they hear you say, keep inventory stock low because faster turnover equals better cash flow and equals lower interest cost, both of which I happen to agree with. But I can imagine people thinking two things. One is, well, I definitely don't want to risk a stock out because that has pretty significant consequences to my business if I run out of stock. So I feel like I hear you saying low inventory is good, but I don't want to risk a stock out in case I have a surge of sales. And then the other thing is my supplier, my vendor has offered me much better pricing if I order more units. So when should I consider buying more units to get that better per unit price versus having less on hand and turning it over faster? Those, I think, are the two concerns that people would have to offset your suggestion of lower inventory, faster turn.
So what I'm seeing sellers do is they would let's say specifically from China, where it takes longer to get stuff. What they'll do is they'll keep like 1 month stock as a reserve in like a 3PL here in the US. And then they'll have containers constantly coming from China directly to Amazon. So they'll figure out what the velocity is and how much they need to replenish, but they'll keep like a certain reserve over here. But the point is not to keep too much over here. Like if and to answer really the other question, which ties into this, in terms of let's say your vendor offers you much a better deal if you take a higher MOQ and you try to do it. What you should do is, start reversing back and trying to see like how much at the end of the day, how much cash is this going to tie you up? Meaning, you don't want to just look, okay, so if I get it for $1 cheaper and I sell 1,000 units, I made $1,000 more. No, it's not just looking at the profit side. It's also looking at the cash side, because how much cash is this going to tie up? And, everybody, cash is limited, meaning, I mean, at some point, everybody runs out of funds. So with the cash, what you want to do is see like, okay, if I'm tying up so much cash, then I have less opportunity on other products. Do I really want to put all my eggs on this product? So it's a little bit like getting the grip where you want to try to really understand how much am I moving on a monthly basis, and then trying to like get to that number. And I agree with you that stockouts is one of the worst stuff, especially with Amazon, because if you stock out, you lose your rank, and if you lose your rank, to get it back, it's not always so easy. I do understand that issue, but on the other hand, what I've seen, and I've worked with a lot of clients, is that if you can get to like a comfortable number, and then you have like a safety stock in a 3PL, which doesn't cost much to store, and then you can kind of like, work with both, working hand in hand.
Makes sense.
Yeah. So we're gonna jump in right over here on a demo site, and then any questions you have, just put in the chat or the Q&A, and we'll take it from there. So first thing is, I'll just jump a little bit into it on the P&L side, which I would say there's like basically three stuff that ConnectBooks offers. One is an accounting automation, which we integrated data from Amazon to QuickBooks, which CapForge does already for you. So we won't be discussing that part. The other two stuff that ConnectBooks offers is you get along a profit and loss, which is detailed item level profitability on an item level, which is completely automated. And this updates every 15, 20 minutes. So whenever you log in, you'll have your latest sales price, you'll see all the fees from Amazon charges, plus the ad spend. Other fees would be like storage fees. We also include today placement fees and AWD fees as well. Plus, you'll have the cost of the product, which we'll discuss where it comes from, and then your profit. If you ever want to get more granular, more detail, you can always hit the plus sign. Let's say, for example, you want to see what these merchant fees are. You get a full breakdown over here of all the different fees. So you can always play around with this. So the idea is that you get, profit and loss, the reporting, automated, and you can also schedule to get emails every day, save as a template. You can customize the column and add a lot more information. There's a lot you can do with these reports, and on the bottom, you have your total numbers. You can also export it to Excel, do pivot tables, and just run different types of reports. So I want to really jump on more on the inventory side, where we start off. So on the first thing, what you do is you have to create yourself an item list. So once you create yourself an item list, now there's two things that ConnectBooks has. One is something called listings, and one is called items. So the item, let's say, for example, you're selling a can of Coke, but you're selling it across, let's say, 3 different platforms: Amazon, eBay, and Walmart. So under listings, it will come in 3 separate times from each marketplace, and it will come in with the SKU it's called. What you do afterwards is you take these SKUs and you connect it to a item which gets set up in ConnectBooks, which is called the ConnectBooks item. So the idea is that your item database lays on ConnectBooks, and then if you have, let's say, 3 different listings, they will all point to the same product. So that's how the inventory constantly gets updated across the different channels and across the different platforms. So it doesn't matter how you list the products, but the main idea is that all your listings will show up over here. And then when you come to the item tab is where you see all your items. Once you have all your items, you go to the listings and you connect it to a product. So then we have something called vendor items. Vendor items would be like if you're buying the same product from multiple vendors. Like, let's say this is more for like resellers. So let's say if you buy shampoo, but you buy the same shampoo, you can buy from 4 different vendors, and everybody has it. Everybody calls it a different name, but in your side, it's one SKU. So you can set up something called vendor items, where you can import a vendor catalog, and then you take those products and attach it to your product. So when you initiate a PO or bills, you can do it based on the vendor item, and then it will link it up to the items in your account. So once you set up your items, the next tab is going to be on the purchasing side. So on the purchasing side, you have the ability to generate purchase orders. So all you do is you do add purchase order, put in a PO number, select a vendor, ship date, arrival date, and then you select the item that you want to, you select an item, whatever you want to purchase. So whatever item you want to purchase, you can also do it by vendor item, this way, the other way. We also have units of measure if you purchase like in case packs. and you want to convert it, that has to be set up on individual item level. And then you have the quantity, the unit cost, and then we have the warehousing. Now, one of the other stuff we have here, let me just pull up an inventory item, let's see. I don't put it, let me see, no, this product. Okay, so one of the things I wanted to show also, which I'll show you, oh, it's on the PO, sorry, okay. So once you put in your unit cost, you put in the total amount, and then you select the warehouse. I'll explain in a minute how the warehouses work. Before we jump, I want to jump a minute to the bills. So the purchase order is before, is when you initiate, where you want your intent to purchase and you haven't received the goods. So you create a purchase order, you have different statuses, open, closed means it's fully received, and you have partially, you can put in memos, you export it to PDF, and then the PDF is what you use to send the event. You can also import purchase orders. If you're using a different tool, you can import it with AI, which is going to be like if you use if it's in a PDF format, or you can do it in Excel. And you can also export all your purchase orders if you want to go it over. You can also filter it based on vendor statuses and different upload types. Now, once you get this, once you receive the goods, then you have the option to enter a bill. Now, when you enter a bill, that will affect your inventory. So the bill would say, okay, now we have more inventory. The purchase order does not affect any inventory. So when you add a bill, you have an option to either do it against the PO, or you can do continue without purchase order, and then it goes in, it goes incorrect. Now, when you add a bill with a purchase order, it will load in all the items. So for example, this one we ordered 500, but we have 150 still on. So you could do, let's say, bill all, it's going to build an additional 150, and then the purchase order will close out. One of the other things we have over here is we have the landed cost. So with the landed cost, there's a couple of different options. You can either put on each individual item, you can put them with the freight and the tariff cost and other costs as well. So let's say freight cost was, let's say, $50, let's say tariffs is another 50. So your new unit cost is going to be $1.67. And that's what will be reflected in terms of ConnectBooks calculating your profitability. So when it comes to us to calculate your profitability and SKU level, the profitability SKU level, we're going to use this cost. Now, then there's an option to add landed cost. So this is really meant for people who bring in containers. Let's say you're bringing a container from China, and in the container, you have, let's say, 5 different products. So what you want to do is the way you want to break down the container cost is based on how much space each product takes up in a container. And that's when you use the CBM. So when you set up your item database in ConnectBooks, I showed before, one of the things you're going to do is on each product, you're going to put in the dimensions. And once we know the dimensions of each product, let's say you say the freight cost is $5,000 and you say use CBM, ConnectBooks will take that 5,000 and it will break it up according to all the different products. And we don't use the same calculation for tariffs. So the tariff depends, there's like a few different options. You can do it by cost, or you can do it based on a vendor or based on an item. So certain products that are in different categories will have different rates. And sometimes certain people have it based on vendor. They don't want it, you can set it up 3 different ways, either by the cost of the product, or you can split evenly, or you can do based on the item. So basically you can set up a tariff rate on each product, or you can do based on a vendor, which you can say for this vendor, my tariff rate is X, and then we apply accordingly. So there's 2 different calculations, and that's all based to get to the exact, product cost and see what happens. Now, once you enter the bill, by default, we put it into a warehouse called not on the order. We usually would go to default warehouse. Now, the way we work with warehouses when it comes to Amazon is we set up usually 3 different warehouses. We set up something called default, then we have something called in transit, and then we have something FBA. So the idea is that when you enter the bill, the initial, that's when we increase inventory, you put it into a default warehouse. And the default warehouse could, let's say, be like a 3PL or something else like that. And once you put it in, it goes into another bill. Just confirm. So when you enter the bill, it would automatically go into ConnectBooks and it would go into a default warehouse. Now, what happens afterwards? What happens afterwards is every time you want to send in shipments to Amazon, ConnectBooks pulls in all the shipments from FBA. And then we also pull in along the statuses. So every time the shipment status updates, we move the inventory based on these statuses. So for example, here you can see this is status receiving. Receiving means it's already being received in FBA. So once the status, so usually working and ready to ship, we usually do nothing. Once the status gets marked as shipped, we'll take the inventory out of the default warehouse and we'll put it to an in-transit warehouse. Once the inventory gets marked receiving an FBA, we'll basically take it out of in transit and put it into FBA. So that's how basically you don't have to be busy in terms of tracking how much inventory to have in FBA, how much inventory to have on the way. Basically, all we do is we automate that process for you, which the inventory moves along all the different warehouses. And if let's say you want to see the information, if you put the mouse over, let's say this 32,000, you'll see, the transfers that ConnectBooks initiated, all the FBA transfers. So this is from in transit to FBA. If we go, and if we go to this one, you'll see these are the transfers from, okay, this is the source warehouse. Looks like this got messed up, but the idea is that we have the source warehouse or destination warehouse where you have in transit where it goes from the local warehouse to the in transit, and then once it gets to FBA, it goes from in transit to FBA. And the reason why we have the transfer separately is because you can send out, let's say, 1,000 units of a product A. So as soon as the shipment is marked a ship, we take 1,000 units from default to in transit. But then Amazon could take like 2 months to receive it, and they can receive 500. Then 2 weeks later, they receive another 300. Then 2 weeks later, another 200. So until they mark the shipment out as closed. So this can go on auto sync where it basically completely automates. Once the shipment gets marked closed, next thing happens is you have the shipment discrepancy page. So here you have all the different discrepancies and based on the product. And then you have different actions you want to do is you can, let's say, sort this by unresolved. And then what you have to do is, let's say this product, was -5, -4, and then you want to adjust it. So you can do like a batch adjust, like you can try to adjust multiple at one time, or you can just adjust each individually. And then we have either you can do an inventory adjustment. So let's say Amazon lost 5 pieces, you can adjust it. Or you can just mark it as resolved if you cleared it out yourself, or you can do clear in transit, which would make an inventory transfer back to the warehouse it needs to go to. So you got 3 different options, and the idea is that a lot of times there's inventory that gets lost in transit, and you just want to make sure that you're accounting for that, so that at the end of the month you really have your proper numbers and not like just trying to guess, how much money you made, because all these things have really a big impact at the end of the day on your profit and loss. So this is on the shipment tip. So once your inventory basically, so the idea is you have your purchasing, you have your bills. You can also, if you don't want to use our PO function, you can also upload or bills with AI, and the bill also will get saved as a PDF here in ConnectBooks if you upload a PDF or an Excel file, so you always have it handy. And then the bill would bring in the inventory to the local warehouse. From there, we have the shipments, which transfer the inventory across different warehouses, and that's how it goes to FBA. We also have the option of doing assemblies. So let's say you buy raw material. For example, let's say you want to sell shampoo, so you can buy, let's say, a bucket. You can buy like a 5,000 gallons of shampoo, and you can afterwards buy bottles and all the other stuff, which you can set up assemblies, and you have to first, when you create the item database in ConnectBooks, what you want to do is when you add the item, you want to add it as an assembly item. So you would create like raw material, and then you would have finished goods, and then as you run a production schedule, you'll go to the assembly function where you build assemblies. We also have disassemblies. What happens with we had certain clients that say they buy products assembled and sometimes they disassemble it for various reasons. So you're able to do disassemblies, and also all these things could be imported. So if you're using like an Excel sheet or something else where you have your production that you're running, you don't have to manually come in and type this all in. You can just give it an import and it should go from there. One other very cool feature we have on the adjustment side, which Matt, you're probably gonna love this feature, is, so we discussed about moving inventory across different places, but one of the things is you also want to reconcile at the end of the month, the inventory. So with FBA, we have something called a bulk adjustment, which you select the warehouse. So if it's an adjustment type, you can do an FBA, and then you'll select the warehouse you have, and you select the store. And when you select the date, This is a dummy count. I don't know if there's much data in here, but the idea is that we can automatically pull the data from Amazon, tell you this is what Amazon says is in your FBA warehouse, and then let's check what ConnectBooks has in your FBA warehouse and then adjust it accordingly. So you don't have to be busy doing this manually. One of the new features we have is that I don't want to get too technical here, but we started basically working a little differently where usually orders, the way most companies do bookkeeping is they orders would deduct inventory and returns would go back to inventory. What we basically do is orders deduct inventory, but returns and adjustments and reimbursements from the financial settlement don't affect inventory. But the way we adjust for that is we pull the inventory report from Amazon on a daily basis and see how it's affected. So what happens is if, let's say I buy something from someone's Amazon business and I return the product, as soon as UPS scans the return, Amazon will refund me. But till Amazon actually receives it, can be like 3 weeks. Until they inspect it, whether it's sellable, unsellable, that can take a long time. So what we do with our new feature is that when Amazon scans it and gives it back, we right away take off the full amount, meaning we show it as a loss. I mean, let's say the product sold for $20 and the cost of it was $10. We won't say you lost 10, we'll say you lost $20. However, when Amazon actually inspects it and Amazon says, okay, we put this product back into inventory, that's when we'll do the inventory adjustment to put it back in. Let's say Amazon says, oops, today I lost 10 pieces. We'll go in and do an adjustment for 10 pieces. Now, in terms of inventory tracking, if utilizing this feature, we will have two FBA warehouses, one for sellable and one for unsellable, where the idea is you track your FBA sellable and unsellable differently, and it will be up to your decision if you want to write off the unsellable inventory. And another feature we'll also have, which also is working, is we have removals. So the same way as we have an in-transit into Amazon, we also have an in-transit out of Amazon. So let's say you do a bunch of different removal orders, a lot of times you can resell those stuff. They're not always garbage. So what happens is every time we pull the ledger board, they say, okay, you remove 20 units from your FBA warehouse, we'll take 20 units out of FBA, put into removal warehouse. And then as you receive those stuff locally, you'll transfer from the removal back to your default warehouse. And then from there, you'll cycle it back into your Amazon warehouse. So the idea is that when we utilize this way of inventory tracking, the idea is that if you want to reconcile your FBA inventory to match exactly to Amazon, one of the things you want to make sure is that you're following every single step along the way, because otherwise you're going to end up with huge inventory adjustments. And if you end up with huge inventory adjustments, then, kind of throws off the books and then you're like, well, I still don't know what's going on. So that's the idea how we do it. And, we actually worked on certain clients and our FBA adjustments at the end of the month were very, very minimal once we implemented this change of following all the steps in Amazon. So the last thing what I want to jump into, and then we're gonna go over, and then one little quick thing is we also have the option to record B2B sales. Like if you're doing wholesale or different sales, you have the option to record B2B sales, and then from here you send it to QuickBooks. The idea is that, if you're tracking inventory, you want to account for everything. And then the next thing is the inventory reports. So the inventory, you have like a basic inventory report, which is inventory summary. You can filter by all the different warehouses and you see the column in every single warehouse, how much inventory you have on hand, and you have the asset value. You can do all different filters. You could also group it by brand, manufacturers, categories. This all needs to be set up on the item level, but once the items are set up properly, you can run all different type of reports. You can also run all different filters, category, brand, tags, all these stuff you can do over here. So this is a very straightforward report, and you have all the different filters. Now the other report, which I really like, is the inventory age. So this is really the main, which I love, is the inventory age, and that's what I'm discussing about understanding how long stuff sit. So the idea is that when you go to inventory age, we'll show you exactly the asset value and how many days it's in stock. Now, one little thing to highlight is that the inventory age doesn't take into account different warehouses, meaning this is just as a whole, because the idea is that we don't want to reset the cycle count when you do an inventory transfer. When we track it from when you enter the bill, from when it was yours, up until you sell it, how long it lays in stock. So you see over here the average days in stock, and then on the bottom, you're able to see the total amount in stock, and then you could see how long it's laying over here. So for example, you have 120 days plus, over $1 million left. So on the bottom, this gives you a really bird's eye view to understanding the health of the inventory and how fast you're turning it on. Now over here, you can also you can um you can you can also add an interval. So let's say, for example, you want to see up to 365 days. You can do 365 days, and you can do, let's say, 15-day intervals, 20-day intervals. So you can change the intervals, and you can do based on how many days you want. And that's how you can change this around and play it over here. So this is the inventory age, which gives you valuable insights once everything is properly set up. And then you're able to see over here which products are not moving. So if you have, let's say, $2 million worth of inventory, you want to see, oh, I got 2 million, but my question would be, okay, so how much of that 2 million is laying in more than 6 months, or laying in more than 3 months, or laying in more than 4 months? And that's really where this report would bring you tremendous value. One last thing is, if you tell me like, hey, Nachman, this number doesn't make sense. Something is off. And I see that many times happening with inventory tools, because a lot of times we're trying to dig into the bottom line of every single one, and we are unable to get to the bottom line of every one. And then with the inventory tool, a lot of times different tools we use, we're like trying to say, okay, can you tell us how you got to this number? And usually you have to run like 6 different reports and backup reports, and not always is the history of the data available. So one of the things we did is we created something called an inventory detail report. So what you do is, if you have any questions on the product, you, let's say, take this product over here. When you go to the inventory detail, you just type in the item. And when you do run report, you're gonna get every single transaction that was done on this item up all until then, till where it matches the inventory summary. So the idea is, anytime you want to audit, or anytime you want to have greater insights, it's simply click of a button, just go in, put the product in there. You can do it by date. You can select all different filters, like whether you want to see just bills, just adjustments, or just orders, or just shipments. You can do it also per warehouse. Let's say you're just auditing the default warehouse. You want to make sure, like, oh, I brought in 10,000 units, but I only shipped out 9,000 to Amazon. Why? Where's these other 1,000 units? And we'll give you the full detail breakdown. So you can see it over here all the way, and you can also export this to Excel and play a lot around with it. So this really gives the backup reports of our inventory summary report, and how you get to the bottom of everything, and how you see how it works. So this is kind of like a very like quick overview, and I guess we'll jump into questions and other stuff.
Yeah, it looks like there's a good amount of questions in the QA. And I think, again, what I really like about this is that you came at this from an accounting perspective, right? You understood the accounting, and then you built a software tool. Every other software tool I've seen that attempts to track inventory and do some of what you've got here, I think it was software guys who built software, and they tried to sort of understand enough accounting to build a software tool, but they really built it from the software side first. This is an accounting tool from the ground up. It answers the accounting questions. It does the accounting tasks that matter, that accountants want to know to get to the bottom line. And it's really built from that perspective. It's just a different way of looking at the same problem, but from that accounting perspective. And that's why, it might be subtle to some of the people listening, the differences and what it does versus other tools they've looked at, but it's really a huge difference. And what this tool drives to is, am I selling my products at a profitable rate, the rate of turnover, the price I'm selling it for, the cost I'm getting it at, and all the associated costs, that landed cost. Just in that one example, you saw how the unit price, I know it was just an example, but it started at $1, but once you added the landed costs, it went to $1.67. And if you're not thinking about that and accounting for that, you are going to be very surprised at how little money you're making, or the fact that you, despite having good sales, are losing money because you're not thinking through all the associated costs of selling that product. Selling e-commerce, selling, products via e-commerce is a complicated business. There's a lot of moving parts. There's a lot of things to consider. And if you're just looking at it from a high level and not really getting into the details, it's easy to go from making a small profit to having a loss. And at that point, you want to stop what you're doing, because the loss is only going to get bigger and worse with volume. So this tool is something that really lets you see at a granular level how your business is doing, and tweak and adjust until hopefully every product you sell is profitable. For starters, that should be the minimum sort of barrier to, having a business running, is every product you sell is at least profitable. And then you can continue to optimize to sell more and more of the most profitable products more quickly. Right. And that's when you're really doing well, your profit margins are really improving, and your cash flow is really solid. But if you don't have visibility into that, then you're really just flying blind. And at any point you could fly into the side of a mountain, and it's game over. So this tool gives you that visibility in a way that I haven't seen other tools be able to replicate nearly as well. So yeah, if you want to jump into the questions, let's do that here. I can pull it up. So first one in is, do you recommend FIFO, which is first in, first out, or average cost for valuation? What's your take on that?
So ConnectBooks is built on FIFO, not on average. We actually have two features. We have the reason why we went on FIFO is because otherwise it's impossible to build out an inventory age. If you run an average, the way the average calculation works is you lose the inventory age. So for me, the inventory age is the most important part because otherwise I'm like kind of stuck. I don't see a way how to like break down an inventory better other than age. So that was for me very important. We do have I do know that a lot of Amazon sellers want average for repricers. So if they're repricing content, they want the average cost. So what we did is we built also in an average cost based on your current stack. So we actually just released now one integration to a repricer, and we probably will have another couple coming out pretty soon, which we're if you're tracking your inventory in ConnectBooks, we can update the repricer on a daily basis with an average cost. It's an average cost based on your current stack, but it's not tracking it on average. And that's how you get both worlds. You get your repricer up to date, plus you also have your FIFO and go from there.
Yeah, I would say FIFO is much, much harder to get, and most tools don't have it. But if you can get that, that is the gold standard of inventory valuation information. Another question is, what report should I review weekly and monthly?
So what do you say, Matt? What do you think?
I mean, I would say the more information, the better, right? I think knowing your profit by SKU is something you want to keep a close eye on. That may not change weekly, but for sure at least monthly. And you want to have a good working understanding of your P&L, of your balance sheet, of your cash flow. Those are all things that are going to help you run your business better. Um, I think sometimes people are scared of the numbers, but it's really a numbers business. And it's not that hard or complicated to learn. You just kind of have to dive in and start, right? And I mean, I know if you're a CapForge client and you have questions, we're happy to provide some education on how to look at that. I'm sure Nachman does the same, so that the numbers that we're working so hard to get to you, you're then able to use usefully. But I think the more the better, really. There's no level where I'd say you're looking at your numbers too much. That doesn't happen.
He has too much clarity, huh?
Right. I wish it was foggier. Um, so next question is, how is inventory age calculated, and what's a healthy rate?
Yeah, so the way we calculate it is based on the day the bill gets entered. So the bill is what would increase your inventory. So usually like around from when you enter the bill, usually it's probably around the time of the receiving, is that's when you would enter the bill. So and from there on, that's when we calculate the inventory age up until it sells. And as I mentioned earlier, inventory transfers when you transfer inventory from one warehouse to the second warehouse, that does not get counted into the inventory age. We had a customer told us they want an inventory age per warehouse. I told them if you take an inventory age per warehouse, you're basically defeating the purpose because if you buy something January 1st, then January 15th it goes to in transit and Amazon receives it February 1st, and your age is starting from February 1st. The idea is you want to track it from when you receive it until you sell it.
Yeah, exactly. What a healthy rate. I mean, I think what we had said before was domestic 30 to 60 days. As it gets older than that, it starts to cost you more and more. And for international, 3 to 4 months, depending on how fast you get your inventory in. But basically, the bottom line is the older the inventory, the less valuable it is, right? The more it's cost you to sit and wait and lock up cash. So the best case scenario is you sell inventory almost as soon as it gets to you, you turn it around and get it sold. So the healthy rate is as fast as possible. Here's a question. Can ConnectBooks help me reduce FBA storage fees by identifying overstocked or slow-moving items?
So yeah, so definitely we actually have a report which we didn't dive into. We have a report built of inventory age based on FBA's numbers. So we have like the report we discussed initially was on a whole, on a picture of the whole business. But then we have one picture where we do have a inventory age based on just what's in FBA. And then what's in FBA basically will tell you how long it's there. So it shows you how much money it's going to cost you and how much money it is costing you. So we have both that we can show you how much it's costing you. And based on that, you're able to see, what's going on with the inventory age.
Yeah, I think the key there is knowing which products it is and then being able to work on reducing the ones that are sitting. Here's a question. At what point does holding unsold inventory start hurting business profitability from an accounting view? And I would say, once you've bought it, the cash is tied up. It doesn't cost you, that item itself doesn't cost you more holding it, but the storage fees do, and the interest expense, if you borrowed the money to buy it in the first place, those, the longer the product sits, continues to cost you money from an accounting standpoint. And then there's the possibility that inventory gets so old that you can no longer sell it at your, original expected price. It's now become less valuable or even obsolete, at which point, it just has to be removed without being able to be sold at all. So there's not a set amount of days, 30 days, 60 days, or something like that. But generally speaking, again, the longer you're holding a product without selling it, the more expensive it is. If nothing else, it's opportunity cost because you don't have the cash to reinvest into another product that you could be selling. Your cash is tied up and you're not getting anything for it. The longer you hold it, the longer your cash is tied up.
That's definitely true.
How often do you recommend doing an inventory write down and how should sellers document it?
Well, the idea really is one of the things I try to now is, setting up ConnectBooks does take, it's a process. So it'll take you like a good month or two to set it all up. And the idea is in the beginning, you might have some sort of write-off if you've never done it. But now the way we work is that we track everything. The way we track everything is since we're tracking all the different steps in FBA, so the write-off will be minimal. But the idea is if you can do it fast and easy, I would say once a month, if not at least for sure once a quarter.
Yeah, it's nothing's more depressing than having a P&L that looks like you had a really good year, and then in December, sometime in January, really, and you write add a big, huge cost extra for write down in December that kills all your profit. So being able to catch it early and add it incrementally, I think is much better for you to be able to see where you're really at. Do you recommend to track inventory per warehouse or location for better accuracy, even if it's more work?
Um, do you, no, definitely per warehouse, is definitely gonna be better because that's how it can be more accurate.
Yeah, I think you want to know not just what you have, but where you have it. Um, and ConnectBooks is already set up to do that. So makes sense to take advantage of that. How do you advise clients on whether to liquidate or hold aging inventory?
So you could, I mean, you should really set yourself up a way how to liquidate it. So in that case, you should be able to get it done pretty fast. Meaning most, what I've seen a lot of big clients work, they have like a preferred method how to liquidate the inventory. So they have a way how to liquidate it. They don't stay stuck with it, but you have to look into it. A lot of times I see sellers never even thinking of that avenue, but I've seen a lot of big customers always have like ways of liquidating it and, they're able to do it.
Yeah, well, we talk to clients about it, and let's say they have $10,000 worth of inventory and they're not sure how long it's going to take to sell or what they're going to be able to get for it. And then we look at, well, what is the holding cost between storage fees and interest and everything else? Suppose, just to make the math easy, it costs you $1,000 a month to have that $10,000 of inventory sit there. Well, that tells you right away, if you hold it for more than 10 months, you've already lost, right? If it cost you $1,000 a month, it was worth 10,000. At the end of 10,000, it's cost you 10,000. So even if you sold it all, right, you lost all of it. So you want to understand your holding cost and what you're going to potentially be able to sell it for. And that hopefully tells you pretty quickly, okay, I'll give it 30 days, 60 days. But at that point, anything that's left, I'm going to remove it because it's going to cost more to sit there than I'm going to ever possibly get for it. But hopefully, again, you're, managing your inventory well so that you're not stuck with a lot of slow moving or not moving inventory. Last question here, and then I think we can probably wrap things up is, have you had a client who actually turned things around dramatically after changing how they tracked inventory?
Oh, big time. Big time. It was like they had no clue what's going on, and they were like finally able to see visibility. I mean, we did a case study with a client who was losing every month money. Once we implemented all the changes, they actually starting to make money, but not just starting to make money, dealing with a few $100,000 in the bank. So if you have no clue what's going on and you're basically shooting in the dark, then you're just kind of shooting. But if you're not shooting in the dark and you have all the visibility, then definitely gonna be right.
Yeah, I would agree. I've seen clients go from having to continuously borrow money just to be able to buy inventory, to be able to pay down their debt and become profitable by cleaning up their SKU list and really optimizing for the stuff that was selling with good margins and getting rid of all the stuff that was selling slowly or at negative margins. And it's not just keep launching new products and hoping for the best. You really have to manage your catalog actively, continuously, to make sure that you don't fall back into that trap or fall into that trap in the first place of having a lot of unprofitable SKUs that are dragging down whatever might be working. And yes, I would agree. You can definitely turn things around by having this visibility if you're currently suffering from it. Now, if you've only got one or two SKUs, right, that's probably not your problem. But even as few as 10 SKUs, you can have two or three that are killing the profits you would have been making from the other six or seven that are working. So not being able to see this is absolutely a problem for e-commerce sellers. So it looks like that's the end of the questions. If anyone has any other questions after this, you're welcome to reach out to myself or Nachman. We're happy to answer them individually just to help you out, get you on track. Thank you so much, Nachman, for going through everything, sharing your tool that you created here and your all knowledge and experience in helping e-commerce sellers do better. I think this has been super helpful.
Yeah, thank you so much, Matt, for joining, and thanks for getting everybody on the webinar. And I do want to end off, we do have a special offer. So we're doing is that if you sign up to ConnectBooks before July 31st, the first, you'll get the first three clients to do it will get 50% off at 3 months. So this is limited to the first three people. The webinar will be is recorded, so we will be replaying this for other people in CapForge, and we'll be emailing this out. So if you're considering this, then jump onto the free trial. There's no charge first 30 days, and afterwards you get 50% off at 3 months.
Yeah, if you're struggling at all with knowing where your inventory is at or making sure that you're as profitable as you can be, to me, this is a no-brainer. Get signed up, get set up. We'll work with you. Nachman will work with you to really give you that visibility and maximize the profitability of your business, because it's an inventory business at the end of the day. So you got to know what your inventory is doing. Awesome. All right. Thanks, guys. Take care.
You
All right.
enjoy.
Bye.